Nissan Joseph, CEO with Metro Brand joins us now. Let's take our conversation forward. Mr. Joseph, good morning. Thank you for joining us. Now, if one looks at the big picture, especially for categories like apparel, footwear, discretionary spends, the industry is going through a cyclical slowdown. What's been your experience at Metro Brands?
Well, good morning, Nikunjan. Thank you for having me. I don't see it as a cyclical slowdown necessarily. I think there's a couple of things that factored into last year, all of last year, and also Q4. One of them is the post-COVID bump that we had the year before that, right? And then once you come out of post-COVID, the spends change a little bit. They get into more of travel, more of experiences, and more of other things that don't focus necessarily on apparel and footwear. Overall, though, we're not seeing anything that signals that there's a slowdown in the economy.
So are you confident that the growth momentum, what you've registered, let's say a profit growth, revenue growth of about 8 to 10%, that's here to stay, and you will grow at least above the India's GDP?
Well, that is the target. I think there are no indicators that would lead us to believe otherwise. The business fundamentals are strong, right? So Metro has strong operational rigor. For last quarter, in our standalone business, we posted very good numbers. We posted 11% growth with a 17% improvement in profitability, right? So those are numbers that we've run to. But more importantly, Nikunj, if you look at the other indicators, such as our EBIT and our PAT, they continue to be in the range that we guided to well into when we had the post-COVID bump up, and we guided to it. I think at that time we were challenged by people to say why we're not increasing that. We knew there was a little bit of a post-COVID bump, so we kept our guidance. We said we'd have PAT somewhere between 15 and 17%. We'd have EBITDA in the 30% range, and all our indicators are that there's no reason for us to walk away from that or be concerned about it.
Nissan, since you did mention your EBIT margins, they've seen an expansion on a year-on-year basis, yes, but it's still below the target that you yourself had set, that of 35-odd%. So tell me, what's the outlook for FY25?
Right. So first of all, Aisha, thanks for the question. When you look at it on a standalone basis, which is important because you have other factors coming in when you add our subsidiaries in. When you look at it at a standalone basis, it is north of 30%. It is actually, I believe, 32% and change. So that continues to happen. And when you do the consolidated numbers, it does come down a tad to about right at 20, if you round up to 29.8. These things happen. One of the things that also affected us there a little bit was the reporting of Ind AS numbers and how we capitalize certain things and how we expense certain things, right? So there's a little bit of movement always in the industry that way. But overall, when we guide to around 30%, we're quite comfortable with that continuing.
Tell me what's happening with the e-com revenues. How are they shaping up? And is it more the physical stores that you're going to be adding upon or focusing on e-com?
Yeah, I think we were quite pleased when we came out of COVID. We were all concerned that would brick and mortar come back? Or is e-commerce going to die off now that people could shop again? And we were pleasantly surprised that both of them kept their growth trajectories, right? Obviously, brick and mortar outperformed the year post-COVID because they were going against very low comps. When you look at our numbers last quarter, we were up 25%. For the year, we were up 33%. And while we were able to control the metrics, the discounts that you take and the costs that you have and the returns that you have, those are more important metrics to us. It's not about just the top line when it comes to e-com. But from a top line standpoint, we were not disappointed. But equally, our brick and mortar stores, consumers enjoy shopping. I think they enjoy the consumer experience of actually going and seeing products, especially in the footwear category. I think there are some categories that are a little bit more, open to agnostic about where you shop, but our category specifically, people tend to like to try on shoes. You can wear shirts and shirts a little bit tight, a little bit loose, but you can't do that with shoes. They got to fit.
Morning, Nissan. I wanted to also understand from you what the outlook is when it comes to the Cravatex business and when is that likely to break even. I understand that currently the EBITDA losses there are at about 11 crores.
Correct. I think, we called last year as a cleanup year, and I'd say I'm pretty pleased with where we ended. We weren't able to accelerate the second side of it last year, not that we intended to, but we were hopeful that we could, primarily because, we had BIS issues, right? So we had to take a little bit of a pause just to figure out how best to address the BIS norms, which is, the government's requirements that they meet certain criteria, which I think is very good for the economy, for the industry. But in the short term, we just needed to get our arms around it before we could start that. We've closed all the stores. We would have closed all the stores. We closed all the stores, but one that we wanted to close for Fila, and that store will also close by the end of this quarter. So we're on track there. From an inventory standpoint of liquidation, we're almost done. We were hoping to be fully done by the end of the year, the fiscal year, but I'm very confident that by the end of this quarter, we'll be done there too. And then we start repositioning the brand. And this year, this coming year, fiscal year, is what we've always said we'll be repositioning the brand. As you know, we demerged Fila and now is part of Metro Brands Limited. I think it has very good runway for growth, and I'm very confident that we will be able to leverage the opportunity that exists in Fila.
So going forward, how much of the growth for the listed entity, which is what we are talking about, will come from brands which are your own brands, and how much will come from brands or JV partners like, let's say, Crocs or Fila?
Yeah, and Foot Locker, don't forget Nikunj, that we also added to the mix. I think in our Metro Mochi stores, what we really look at first and foremost is that we want to keep our own brands at about the 70% range, and it's maintained that, right, over a course of a long period of time. It flips up and down a little bit, but for the most part, it stays at 70%. Obviously, we are adding Foot Locker to our mix. Obviously, we are also going to grow our Crocs stores and our FitFlop stores. But today, from where we sit, we don't see that considerably changing the overall mix, because as they grow, so will our core business, right? So it's not like we've stopped growth in our existing brands and we're only doing growth in the outside brands or the outside concepts, whatever you want to call them. We're growing both of them. So as a percentage of business, I don't think it's going to see a significant shift over the next few years.
Would you be looking at expanding this entire JV portfolio, if I may use that word? Is JV the right word to call this?
It's technically
franchise?
a light. It's
technically right.
Yeah.
Okay.
It's a franchise license. Yeah.
So if I say there are companies which in a sense have really enjoyed this entire JV stroke licensing, companies like Jubilant Foodworks, I mean, they have the Domino's franchise, Jockeys, or Page Industry, the Jockey franchise. For Metro, how big this business could be where you are able to grow the JV or the so-called licensed brands? And when you're getting them into India, are these multi-year contracts? Are these yearly contracts? How does it work?
Yeah. So I think there's three parts to that question. Part number one is, what is the future of these kind of, and in one word, I would probably call them international brands more than JV brands, because a lot of them come into the country under different agreements and licenses and what have you, right? So when it comes to those international brands, I think there's a huge runway for growth because India is definitely more connected. It also has much more of an aspirational customer today than we did before, and tomorrow than we do today. So that's going to continue to grow. Having said that, though, one of the things that Metro Brands enjoys is a stable of brands of Metro, Mochi, and Walkway. That is our own brands, our legacy brands that have great traction in the country, great brand awareness in the country, and great runway for growth as well. So we see it as an and opportunity as opposed to an or dissonance, right? It's not do we do this or that. We believe both of them have immense potential for our economy, number one. And as you know, Metro is well capitalized and operationally competent to be operating those stores throughout India. So we see that as both two distinct best opportunities. When you look at individual companies, they may skew one way or the other because of their structure or their capabilities. But Metro definitely has the capabilities to grow international brands in India as well as their own brands.
Nissan, the other thing I wanted to talk about, and please correct me if I'm wrong here, it seems that your average realizations have dropped for FitFlop, which seems, which is clearly a premium category, and have remained flat for Walkway, which is a mass category. Now, the read-through across sectors is that it's the urban consumption, the premiumization, which is currently at play. What is your own reading? And in regards with that, then, which is the brand which is going to be the performer for you in the next, say, 2 to 3 years?
Yeah. So I think there's two different aspects to that. One is what's the ASP going to do and what's going to perform, right? I think unequivocally, what's going to perform, we believe, is all our brands, right? Albeit at different ratios. FitFlop will not have the same growth, for example, as the Crocs had when they first started. But that doesn't mean it doesn't have legs for growth. So that exists there. You will see these kind of blips up and down on average pricing, but none that concerns us. FitFlop, you called it out as a specific example, so I will respond to that. You are correct, but it's also because we introduced a line of what they call the eye cushion shoe, which has a different look and a feel and a different price point. It's still premium in that category of shoes, but compared to the original and full line of FitFlop, it is not as expensive. But they're both premium in the categories that they play in. So we introduced a new category last year in FitFlop, and that's what caused that shift. But it's still a premium category in the category we launched. So that's the way I would look at that.
All right, Nissan, thank you for taking time out and joining in. Always good to get in a perspective as to how you guys are walking the talk, really, and how business is shaping up at Metro. That's the word coming in. EBITDA margin guidance at 30% for FY25 and a huge growth runway when it comes to international brands. 1163.
If you like this video, then like, share and subscribe to ET Now.